Okay, so I think we have given everybody a lot of time to join us. I just firstly want to thank everybody for joining this afternoon. I'm really excited about this topic. It is actually something that I can talk about ad nauseum for hours, but you only have me for 45 minutes, so I will not bore you indefinitely. Just by way of introduction, my name is Cinzia De Risi. I am a mobility tax expert. I have been working in tax for about 30 odd years, of which about 28 have always been in the people's tax arena, payroll taxes and mobility taxes. So that's literally me in a nutshell. I don't necessarily want to bore you more than that. Just to let you know that the presentation has got 6 main areas that we're going to be covering. I do want the session to be as interactive as possible. So if it's quite all right, I will take questions as we proceed, and perhaps those 6 subheadings are going to guide us as to when to pause and address any questions that you may have. I see a lot of you have found the chat function, which is great. Thank you very much. There's also a questions section. So if you want to start typing your questions as we go along, you are more than welcome to type them. If not, we will then pause and you will have the opportunity to ask your questions. So if everything is, if everybody's comfortable, I think we will then start. So thank you. Okay, so as I said, there really is today, it's really about this whole concept of tax immigration that has really been a buzzword for a couple of years, but more now than ever before, as SARS continues to change the legislation. And South Africans are looking at their situation and saying, do I want to stay in South Africa, yes or no? Okay. So really today, I'm going to pause. As I said, there are these 6 main headings. I'm hoping to get through them all, but we'll see where your interest lies and we'll rather stop there. And if we see we run out of time, we can always set up a second session. Okay, so really what I really wanted to start with today is who is a resident? And the reason I've started with this is that in all my years of consulting, I have come across many people that are really apprehensive about tax immigration. And the reason is they keep having concerns about, will I lose my citizenship? And when the concept of financial immigration was still around, a lot of people believed that they needed to financially immigrate to be able to tax immigrate. So really what I wanted to start with today was really to unpack, to say, you get different legislations, those that regulate immigration, tax, and exchange control. And each of these legislations have their own concept of a resident. And while sometimes they do interplay and interact, these terms are not mutually exclusive, right? So if you are going to be tax immigrating, it doesn't mean that you need to renounce your citizenship. Just on that point though, I was actually watching something yesterday where I understand that the Department of Home Affairs is actually renouncing a lot of citizenships for people who haven't asked whether they can have dual citizenship. So it's just something, a little nugget that you need to bear at the back of your mind, is that if you are going to be obtaining citizenship in another country, do apply for a letter of retention from Home Affairs. Okay, so really back to the topic today is, as you can see, the definition of a resident is absolutely key. So when we're looking at tax immigration, really what we need to focus on is who is a tax resident. So if you fall within the definition of a tax resident, you are going to be regarded as residents. Converse applies. The minute you don't fall within this definition, you're no longer regarded as tax resident, and AKA you have then basically tax immigrated. So the starting point is the Income Tax Act and the definition of a tax resident. So the South African Tax Act has got 2 main tests of a resident. Okay? The first one is somebody who's ordinarily resident, and I'm going to shorten that to OR, else I'm going to waste unnecessary oxygen on saying ordinarily resident all the time. So if a person is not OR, the second test is a day's test called the physical presence test. Now, we're going to look at these two tests in a second, but what I really want to stress is that there's this lovely escape clause, and it applies to both tests. So this is where a person is regarded as resident in another country. You are automatically not regarded as tax resident in South Africa, right? It is a choice because you need to be resident in that country in terms of a double taxation agreement that South Africa has with that country. Okay, and I will come back to this concept because there's a lot of detail that we can unpack there. But I'm going to pause a second and just look at the two main definitions, right? So ordinarily resident, the first test, is a concept that really is not defined, but is a principle that really has come across in case law. Now, many of you would have heard a lot of people keep saying it's the place to which you would return to after your wandering. So it's a very famous court case, and that basically laid down the principle to determine whether you are O or yes or no. And really, it's about the concept of, do I see South Africa as my home? Is this where I've set up roots? Is this where I belong and will always return to no matter where I go abroad, right? And because it's a very subjective test, there's no ways that SARS can really test your intent other than by looking at external factors. So they have issued a list of factors where they're saying we need to look at what steps and what actions you've taken to support the fact that you're telling me you are not resident in South Africa. Okay, so that's the first test, right? I have put down the physical presence test here, but really this is really not a test that I would look at to tax immigrate. It really is an absolute last resort. And as you can see, the reason why I'm quite hesitant to use this is because it's really much numbers and counting days, which if you're leaving the country, you don't want to necessarily have to continue counting days. But on that point, the reason it is there, it depends on how you basically tax immigrate, that days still become an important factor. Okay, so after all that rambling, if I really had to sum this up for you, and how does a person then tax immigrate? You fall outside the definition of a resident, two clear ways. You always start with the exclusion and you start with looking at the DTA version, right? So this is where you are going to leave the country and you become resident in another country, and we have an agreement with that country, right? If there is no double taxation agreement, then I would then say you would then revert to the second way of ceasing residency, which is looking at that very subjective test of, is South Africa still my home, yes or no? And as I've mentioned before, the way that you cease is important because sometimes you would still be falling foul of the second test if you are not ordinarily resident or you can't support that you're no longer ordinarily resident, then you do need to look at that day's test. Okay, so I'm actually going to pause there and I am going to have a quick look to see whether we have any questions or give you an opportunity to raise your hand to ask me anything on the concept of a resident. Okay, I can't see any hands, so I am going to proceed. Hang on, there's a question, great. Okay, so the question is, how do differing tax years work, e.g. South Africa and Mauritius differ? How are the in-between years handled? Okay, great, very good question. And it all, okay, Richard, we'll come to your question in a second. So different tax years, so when you're looking at ceasing residency, timing does become quite important, okay? So when we're looking at the first option, and you'll see that the recommendation that we do is how to apply the double taxation agreement, you first need to become resident in that country, right? And so the date in which you cease residency is going to be very much dependent on that, right? So DTA residency, tax residency is not something that you do either at the beginning or the end of the tax year. You can, But when you cease residency, in effect, you can choose any particular day in that particular year and saying, this is the day that it's either the factor supported, or I can get a tax residency certificate that supports this particular day. Then what happens is that you are regarded as tax resident up to that day. And then from that day, for the rest of that tax year, you are a non-tax resident. So the interaction between different tax years or different countries' years are not that critical. They do come into play because what is important, like for example, so if you become tax resident in Mauritius, you can say the day that I become resident in Mauritius is the same day that I cease residency in South Africa. So it's very rare that you'll get an overlap period where you're regarded as resident in both countries. I'm hoping that that has answered your question, Michael. If not, just pop me a note and we'll come back to that. Richard, you've asked about temporary residency. Residency is a tax concept. There's no such thing as temporary residency when it comes to a tax concept. I believe you might be referring to an immigration status. If you don't mind elaborating on your question, we can maybe pause to understand what your concerns are. And then unfortunately, I've got Anonymous who said, will ask me later, but you're struggling to understand why an election when living in another country. I can't understand why an election when living in another country, DT says you shall be deemed. Okay, so very good question. And it's actually a very interesting, there was actually a case law. So you can actually, in terms of law, be regarded as tax resident in two countries at the same time. It's only where you want to say, I actually only want to be resident in one country, where we say you invoke the DTA. So as a taxpayer, you can say, I want to rely on the DTA, okay? And that means you've invoked it, and then yes, you will have to choose one place to be your country of residency. But you're not forced to actually make that election. So I have in the past have had clients who said, yes, I have become resident in the country that I've moved to, but I don't want to cease residency. I want to retain, and I'm not certain what my future plans are. I might one day want to return to South Africa, and I am going to argue that I'm still ordinarily resident in South Africa, and I file as a tax resident in two countries. It's not ideal, but it is possible. Okay. So let me just see there is a further question. I'm hoping, Anonymous, that I have answered your question. And perhaps what we will do is we'll just move on to the next section, and that will perhaps answer some other questions that you might be having. Okay, so as I've said, when we're looking at tax immigration, this is what I would always refer to as my first option, right? As you can see in the black I've used or highlighted a lot of terminology that is used that all mean the same thing. Okay, so when we're looking at tiebreaker, exclusive residency, DTA resident, they're all actually referring to more this whole concept of ceasing residency by applying a double taxation agreement. Okay, so firstly, as I've mentioned before, you do need to start and saying, I've moved to a new country. I'm going to become tax resident in that country in terms of their domestic law, right? So each country, like we've got our two tests, they have their own laws about how you become a resident in that country. Some of them, you could trigger residency from day one, depending on circumstances. Most countries have a 183-day rule that says if you have been in this country for 183 days, you are regarded as tax resident. Most of them will make you tax resident from the beginning of their tax year and not necessarily from day 184. And that is how you then saying, well, if I'm now resident in my new country, and technically I'm still ordinarily resident in South Africa, I'm resident in two countries. I then look, does South Africa have a double taxation agreement with this country that I've moved to? And if yes, then I look at the treaty provisions. So all double taxation agreements do actually contain a clause where it's an article that is called the tie break clause. Okay, and this is really, it's a set of sequential tests that basically you take step by step to determine where am I resident. So I can't be resident in both. One of these two countries will ultimately be the place that I'm regarded resident. Okay, so you move from one test to the next test until you get an overall winner. So if we're looking at these particular tests, the first test is, where do I have a permanent home available to me? So if we're looking at permanent home, it's not necessary that you own your new home. If it is on a lease or you're renting it, that will suffice to be regarded as a permanent home. The converse also needs to be just addressed. So if you're leaving South Africa and you have decided not to sell your home, but let it, that home is no longer available to you because you cannot evict your tenant at the drop of a hat. So even though you've got a property in South Africa, it doesn't mean that you've got a permanent home in South Africa. Okay, so if that first test is not conclusive, in say many people might have a holiday home that they don't let, right? You can move on to the next test, which is then your center of vital interest. Now, this is the test that basically looks at where your personal and economic ties are the absolute closest. And I have seen most of the developed world tax authorities, when they're looking at this particular test, for them it's sufficient to say, how are you working in my country? And is your immediate family with you? And those two conditions for them is sufficient to say that your center of vital interest is now in our new country, right? It's a very narrow interpretation of this concept, but if you're trying to cease residency, well, you know what, you'll take it because it basically helps you cease residency in South Africa. If your activities or your job is such that you're perhaps spending time here and there, perhaps your family hasn't accompanied you, or you're not getting a very clear answer on the second test, then you would move on to the third test, which is your habitual abode. And it's basically exactly what it says, right? It's on a day-to-day basis. Where do I spend my time? Where do I go to work? Where do I go to gym? Where do I join clubs? Where do my kids go to school? What is my day-to-day living like? And that gives me an indication of where my habitual abode is. Okay, so on the chance that that still doesn't give you a very clear answer, you move on to the next test, which is the nationality. Okay, so where are you a national of? And the absolute last resort is if the above tests are not conclusive, then it basically will be referred to the tax authorities for them to agree by mutual agreement. Okay, I have only heard of one case that had to be referred to the revenue authorities. Most 99% of cases, you will be able to determine your residence in terms of this test by the first, second, and absolute worst case scenario, your third test. Okay. Now, the reason why I've always recommended this as my preferred method, if possible, to cease residency or to tax immigrate is because it's a very black and white method to cease, right? Once you are resident in your new country, you can apply for a tax residency certificate from that tax authority. And that basically it's a certificate that says, Joe Blog, we are regarded as tax resident in country B, right? And I've actually seen some tax residency certificates go as far as saying, as in terms of the double taxation agreement between South Africa and our country, you're regarded as a resident in my country. And why that is great, it's black and white proof that you can submit to SARS as proof that you've actually tax immigrated. They cannot necessarily dispute. So if they have an issue with your residency certificate, they need to take it up with the tax authorities and not you. Okay. So I put a little tip here because the beauty of a double taxation agreement, it's not just a means of how you tax immigrate, but there are sometimes certain clauses in your DTA that can actually help and be quite beneficial. But they are very much time dependent. Now, I'm hoping we're going to have enough time to get to the retirement section, but that was one point where you could make use of your double taxation agreement and really limit your tax exposure in South Africa on your retirement funds, right? Now, there's a handful of DTAs that do provide for that, but what I'm saying is don't just jump, right? Rather look at your DTA holistically before you make any decisions because timing can be quite important. Okay. So then we move on to the next way, which is option 2 of tax immigration. So as I've said, if you move to a country and there isn't a double taxation agreement, then you will need to revert back to the OR test. And as I've said, it is a test that is not as clear cut. It's subjective. So you would need to basically write a motivation to the tax authorities to support and list all those factors that say, you can see, I've sold my home, I've sold my investments, I've joined, or I'm applying for citizenship in that other country, I'm on a fixed term contract in that country, I've got no intentions of returning to South Africa, right? Because it is subjective, the burden of proof is on you, on the taxpayer, to be able to support this. And as I've said, SARS has given a list of factors that they would look at, that you would need to look and motivate, okay? There's not any one particular factor that is conclusive. So generally, it's like an overall impressions test that you would then create. You look at all the factors and you motivate those that support your case. So as you can see, when you're looking at the factors that they've listed, they are quite aligned to the tiebreaker clauses, but they're all together, right? It's not step by step like the DTA tiebreaker clauses. So they would, like I've mentioned, they would look at your immigration status, your work status, is my family with me? How long am I going to be there? How often do I come back to South Africa? So there's a whole host of factors that can come into play there. Okay, so I'm going to pause there because we actually have a few more questions, and that is a natural stopping point. Daniel, so you have asked, that's correct. So Daniel has asked whether a person can apply for a tax residency certificate once you've tax immigrated, or is it only after a period of time in that new country? So generally, Daniel, the answer is once you've triggered residency in terms of that country's domestic laws, that is the first time that you will basically be resident in 2 countries and you can apply for one, right? Many times you will have to perhaps even wait for the first tax return that you filed in that country for the tax authorities to consider it. It does depend from country to country what the rules are. So, but yes, you do, unfortunately, it's not something that you can apply for beforehand. It's something that you do need to wait for and then apply for that. But when you're looking at how you notify the South African tax authorities, it is also not necessarily on the day that you get on that plane. So you've got a little bit of flexibility on time as far as that is concerned. Okay, any other questions? I can't see any additional questions. Does anybody want to raise their hand? Okay, yeah, I think there's a new question, is there? Oh, sorry, Dave. Mauritius allows for the digital nomad for remote workers and rented a property for 12 months. Okay, so Dave, yes. So the Mauritian, the digital nomad one, yes, correct. So if you are leaving and you are renting a property, you are going to be able to qualify and saying, I'm going to apply the DTA between South Africa and Mauritius, and you can tax immigrate, right? As I've mentioned, it is a choice. If you want to retain residency, you can do so. It is not necessarily advisable because of the change in the exemption for foreign remuneration, where your foreign remuneration is no longer fully exempt, but is capped to 1.25, right? But it is, and tax immigration is very much a personal decision. It is dependent on facts. So it depends on, are you only going to, is your intention to be in Mauritius for 12 months? What is your remuneration levels? Is this something that is a stepping stone to move abroad? So it's not really a very simple yes, no answer to this. But if your question is can I tax immigrate if I am moving to Mauritius for 12 months? Yes, you can. Okay. Badna, you've asked if my employer rents on my behalf. That's 100% correct. You do not need to be the party to that lease. You've got the right to that premises, and that is sufficient to meet the condition of permanent or permanent residency for the tiebreaker. Okay, so that was your first question. It's not exclusive use. The other person has a right there. Forms part of my tax bill. Yes. So short answer, yes. A lease agreement entered into on your behalf by your employer will definitively meet the condition of a permanent home. Okay. Emma, you've asked what is the difference between tax immigration and financial immigration? Very good question, Emma. So financial immigration really is a concept that's now fallen away. So financial immigration was the process, and it was a formal process that you had to follow to change your exchange control status from being a resident to a non-resident. As I said in the very, very, very first slide, is you've got the concept of a resident for tax and a different one for immigration and a different one for exchange control. The whole concept of financial immigration revolved around the concept of a resident for exchange control. Okay, we will get to it later on, but financial immigration has fallen away. The Reserve Bank has modernized their systems and they've done away with financial immigration. There is no such thing post-March 2021. Okay, but we will get to the exchange control if you have got questions about that. So when we're looking at tax immigration, it really is changing your status from a resident, tax resident, to a non-tax resident. Okay, I'm hoping that's answered your question. Okay, and I have lost my place, just bear with me for a second. Okay, so really the difference between a resident and a non-resident from a tax perspective is really a resident is taxed on worldwide income, a non-resident on source, right? But when you change your tax status, it does trigger a CGT event. Now, there's a lot of terminology that goes around regarding this. You might have heard the concept of deemed disposal or CGT exit charge. Once again, terminology, multiple terminologies, all refer to one and the same thing. And this is the CGT event that is triggered by the change in residency. So what happens when you change from being a resident to a non-resident? The Income Tax Act deems that you sold your worldwide assets on the day before you tax immigrated. And so what is the selling price? They basically deem it that the market value on that date is basically your selling price. And so that increase in the value of your assets from the day you bought it to the date that you tax immigrate is what they're trying to catch into the net. And this whole issue about the exit charge is really the reason why many people in the past were really hesitant to tax immigrate. And it wasn't necessarily necessary because we had a very generous exemption if you were working abroad. But with the limitations to that exemption, more and more people are saying, no, it's now time, I'm paying this once off exit charge, but then I am no longer regarded as resident in South Africa. Now, when we're looking at the exit charge, it's not as daunting. I know many people are very concerned about, I'm going to be paying this once-off tax on everything I own. But if you look at the construct of the CGT legislation, and even there are specific exclusions from the exit charge, it's not always as bad as initially you think, right? So two things that are completely excluded from the exit charge is fixed property in South Africa. And secondly, any unvested share options, okay? Now, don't get too excited. The reason why they are excluded is because the tax event is recognized at a later stage. So the taxman gets his pound of flesh either when you sell your property in South Africa, and when you're looking at restricted share options, it's when they become unrestricted, and a portion of that relates to South African services, they basically get you there. And that is the reason why they're excluded from this extra charge on tax immigration, right? But then if you're looking at the 8th schedule of the Income Tax Act that actually regulates what is a CGT, right? There's a whole host of assets that are always just automatically excluded, right? So your personal use assets, motor vehicles, jewelry, household goods are not CGT assets, right? And even a boat, to the extent that it's not over 10 feet, you can say that is a personal use asset, and hence you don't pay CGT on that if you leave the country. There are certain investment vehicles, such as a South African endowments, certain insurance policies, life policies. If you've got a personal loan or a loan in a trust, those are not assets for CGT purposes. Foreign currency, so if you've got a fixed deposit and it's in pounds, if there's been a gain in that investment because of exchange control, fluctuations, that is not an asset. And technically, retirement vehicles, pensions, provident, retirement funds are not CGT assets. I've put an asterisk there because there is a proposed legislation where there's an exit tax on these retirement vehicles, but just bear in mind it's a separate exit tax that they're talking about. It does not make the retirement vehicle a CGT asset. So the calculation doesn't fall within the CGT calc, but we'll get to that time permitting, which I think is a very topical aspect, and I'm hoping we do get to it. Okay, so if I had to summarize it, how does it then work? If you tax immigrate, you've got your deemed disposal on your worldwide assets, excluding fixed property in South Africa and excluding those other assets that I've mentioned earlier. You calculate your gain or your loss by looking at what's the market value in the date that I immigrated, less my base cost, my original cost price, plus improvements, acquisition costs. There's a whole host of rules that you can look at there to get your gain as small as possible. You calculate your gain, you are still entitled to your 40,000 exemption from that gain, and then your inclusion rate of 40% falls into your taxable income. Okay. Also very important, when there is a CGT to be declared to the tax authorities, it's not a separate form that goes to SARS. You basically declare this in your annual tax return, the return that you file after that, after tax immigration. Okay. And when we're looking at tax immigration and the timing, this is something that is very vitally important, because you don't necessarily, there's not always a fixed date that this is definitively the date that I'm going to tax immigrate. You do need to look at it and saying, well, you know, if I'm going to be paying an extra charge and I have multiple days or dates that I can let the tax authorities know that I've changed my status, I need to look at CGT and saying, on which date is my CGT the lowest, more beneficial for me to make that declaration. Okay, I see we do have a whole host of questions. I do want to just pause and perhaps just wrap this up a quick second, is that I have been asked many times by clients that says, I had my primary residence in South Africa, I couldn't sell it when I left, I've now let it, but now I want to sell it. And as you know, if it is your primary residence, you're entitled to a 2 million exemption from the gain. And many clients have asked me if they forfeit that. And the answer is no. You don't lose your 2 million. There is an apportionment that does need to happen, in that you would, you know, if you make a gain on the sale of your primary residence, and in the current climate, it would be fantastic to do so. But in the event that you do, that gain is apportioned. And they're saying this is the gain that relates to the time that it was your primary residence. And against that portion, you can offset your 2 million. The portion of the gain that relates to the time that it was an investment property or let, unfortunately, will not qualify. Another point is that, as you know, that if a non-resident sells property in South Africa, you are subject to a 7.5% withholding tax on the process, calculated on the proceeds, not the gain. And I have seen that some transferring attorneys are asking South African immigrants, saying, oh, you've immigrated, you're no resident, I'm going to apply 7.5%. Okay. In that event, please note that not all is lost. Firstly, it's not a final tax. It's almost like a provisional tax that is you pay until you've been able to declare the real situation to the tax authorities. But in many instances, you can get this 7.5% reduced and even basically down to zero. So for example, if you sold the property at a loss or you're entitled to the 2 million, you can apply to the tax authorities. You basically do it in a pre-scout form called an NR03, submit it with the offer to purchase and your calculation motivating why the 7.5% is too high, and they would have to then return and lower that. This is once again a good place to pause, and I'm going to be looking at the questions. Okay, I think the last question was Emma. Michael. Okay, so Michael, you've asked, is property held in a company also not impacted? Michael, the thing with the property, it's not just fixed property, but also if you have an interest in the fixed property. So it depends on how it is held or shareholding, so forth. It could potentially well still be an asset, right? I'm not certain that's answered your question. I hope it has. Mike, US cash investment balances were taken. Okay, out of mind. Yeah. Okay, so Michael, Mike, I hope I've answered your question. So if you've got a US cash deposit, okay, so if it's a cash deposit held in cash, then the exit charge does not apply. However, if you've gone and you've invested it in some form of equity, then yes, it will be impacted. So if I had to just basically summarize, based on my years of calculating exit charges, the most common asset is anything that's equity-based, okay? And that can be in ZAR or foreign currency. It's unit trusts, shares, and I know I had somebody that asked me the question whether cryptocurrencies would be caught by the exit charge. In terms of SARS's manual, and they've given guidance that they do not see cryptocurrency as a currency, but as an asset. So yes, that would be caught. But there's a couple of ways that you know, it's not always just black and white. You do need to look at the circumstances. Oh, there we go, Liv. I hope I've answered your question. So yes, cryptocurrencies is regarded as an asset, so it would. Also remember though, the basic principle of any asset, be it cryptocurrencies or a share that you hold, is that's the first step is, yes, it's an asset. But second step that you need to look at, am I holding this for speculative purposes or am I holding this as an investment? It's that whole debate of capital versus revenue or the tree versus the fruit. So once again, there's not necessarily a black and white answer. We would need to look at, you know, what is your intention of holding your cryptocurrencies? Is it speculative, yes or no? If it's speculative and you've made a gain or a loss, have you declared that as such to, you know, to the tax authorities? So in principle, yes, crypto is an asset and is subject to the exit charge, but it is case by case. So when you're looking at base costs, the normal base cost rules applies, Mike. So owning a property for 30 years, yes. You've got multiple ways of looking at how you determine the base cost. And obviously, if you've got if it's a pre-October 2000 asset before the introduction of CGT, you obviously can do a time apportionment. Obviously, any property that you've spent incurred costs on, such as improvements, or obviously you can adjust that base cost definitively. Okay. Also remember that a whole host of costs form part of base cost. So transfer duties, legal fees, estate agents fees, there's a whole host of assets that can boost your base cost up to a higher value. Okay. Emma, you have asked piece of paper, ultimate proof, financial technology. Okay, so Emma, I'm hoping I'm going to actually touch on your question in a second. So if you don't mind holding on for a second, is how do I do now that I'm tax immigrating? How do I do it, and what proof do I need? It all depends. Like you've said, you've gone through this process. So if you have immigrated and you financially immigrated, and you want certainty from SARS, you can actually apply to them and ask them for confirmation of your status. But I will get back to that because there's a couple of ways of doing that, and I'm hoping I'll be able to answer your question in a minute. And hello, Deborah. Good to talk to you. Okay, Deborah just wants us to thank you, Deborah. Thank you very much. Deborah's answered your question, Mike, as to the interest in the movable property. Exit tax will be paid by your company, not by you. Okay. If you liquidate investments into cash before exiting. Okay, so Mike, my advice is never to make an investment decision purely on tax. Okay. Obviously, if you are going to liquidate an investment before you exit, you are going to be basically realizing an actual CGT, right? As opposed to the deemed, but there may well be a CGT event. It's just actual versus a deemed disposal. The holding period recognizes for equity, there is a presumption that you can hold an asset for 5 years. There is presumption that it is held as a long-term capital investment. So that is the magic number there, but it's not to say that if you've held an asset for, if you've held an asset for less than 5 years, that you cannot argue that it is a long-term investment. But number 5 is the number that revenue has given. Okay. Correct. Okay. Okay, so Deborah, I don't know if you are, I know you've just made a note, the exit tax to be paid by the individual on shares when ceasing residence, correct? Okay. So obviously, just on that point, and I think this is maybe just clarify that if you are holding your property or a property in a company, remember, an interest, a company, be it listed or unlisted, is actually an asset for CGT. So it all depends on your shares in your company. Those shares, right, would, and you've got different ways that you can value your shares in a company. You can either use a discounted cash flow, or you could use a net asset value, but you do need to value. A lot of people have private companies, and you do need to be aware that if you've got a shareholding in your private company, that shareholding is a CGT asset for purposes of exiting. Okay, that was the last. Oh, yeah, okay, actual CGT. Okay, great. Okay, I am conscious of time, but I'm hoping that we don't have too much to cover and that we can get through. So how do I let SARS know? And I'm hoping this answers some of your questions. I have marked it as current and prior year, but really it's basically people who are looking at immigrating at this point in time. When you basically tax immigrate, it's not a separate process, and you do that declaration to the tax authorities when you complete your annual tax return. So it's one of the legend questions that come up saying, have you ceased residency? You'll be prompted to put in a date, and then the CGT page will automatically pop up when you've made that selection. Don't worry, if you have got no assets, you just complete it as a null and on you go. When you submit that return will be probably routed for manual intervention, and SARS will then validate that they are comfortable with the declaration that you've made. You may well be asked for additional information, and that's just standard information that we will touch on when we look at the second part. So that is how you basically tax immigrate. You do it via your tax return. Okay, nothing more complicated than that. That being said, though, SARS has been aware that there are many people who have left the country before this method of letting SARS know via your tax return. And I stand to be corrected, but I think that question on the return has only been there for the last 3 odd years. So if you've left before then, there was no means of letting SARS know, right? Not formally. And so what SARS have said is that if you want, or actually they're actually advising that if you have tax emigrated and you have not notified them in the past, that you need to do so via this declaration, right? It's a form on e-filing. It's called Declaration Ceasing or Cease to be a Tax Resident. And you need to email this completed form with supporting documents to them. And that is your way of letting them know of historic tax immigrations, right? Now, the form really actually asks you for 3 things. It asks you for the method in which you tax immigrated, and those we addressed above. the date of immigration, and then supporting documents, right? So the supporting documents that they ask you is really much linked to the method applied. If you've ceased in terms of a double taxation, they'll ask you for a tax residency certificate. If you've ceased in terms of OR, they'll ask you for the detailed motivations. And so really it is case by case, it is method by method. And if anybody is interested in what those requirements are per category, I am happy to share that with you after the call, okay? And I think, Emma, I think you had asked, somebody had asked whether they have financially immigrated in the past. What do you do now? If you want formal confirmation, you can apply to SARS by letter asking them for confirmation, or you can complete the declaration to be ceasing to be resident. Now, I would strongly advise that you do get some form of confirmation from SARS, and you will see that it's twofold. Firstly, you want certainty. You don't want your residency status to be disputed or in question some years down the line. Secondly, if you do have retirement vehicles in South Africa and you want to exit those, there is a link to having to be non-tax resident for a prescribed period of time, and you want to be able to prove that you've met that prescribed period. So always a very good idea is to advise, is actually to go through this process and do the formal confirmation. Okay, I am going to pause. I see that there are a whole host of questions. No. Okay, I don't see any additional questions. So I am I've got a couple of 17 hands raised anonymous. Financial immigration done. SARS is the only way to get blocked now. Unblocked funds is without a FIA. We are going to touch base on your immigration and getting your funds out. So you are right that so the concept of financial immigration has fallen away. And what we will get to the slide, but what SARS is now trying to do is they're trying to basically align the exchange control regulations for a ex-con resident much to be similar to an immigrant. But we will get to that. Anonymous, I'm hoping I'll get to your the question. If not, I will make a note that we will come back to that irrespective of time. Okay. Okay, so if we're looking at, and there's a couple of points that I really want to touch on, and I'm going to go through this quite fast. A lot of people have asked whether or not they actually still need to be registered taxpayers after they've tax immigrated. Do I need to file a return? Once again, it depends on facts and circumstances. If you have tax immigrated, your status changes, and it can change in the middle of the year. So you can be resident, non-resident in one filing year, and you make that declaration to SARS. If you once you're a non-resident, you're only taxable on South African sourced income. So if you're continuing to earn South African sourced income, unfortunately, you do still need to file a return and notify SARS of that income, right? And that generally would be passive income. So if we're looking at passive income, rental property, dividends, interest, right? I've made a note there that, as you know, that if you are earning interest, and this is interest from South African shares, you would be subject to a 20% dividends withholding tax. But if you've ceased in terms of a double taxation agreement, at times the double taxation agreement can lower the tax rate, okay? And you might want to then file a tax return to actually make use of that lower withholding. Interest, South African interest would be taxable in South Africa, but there are two possible exemptions that you can rely on to actually get that interest either totally out of the net or partially out of the net. So once again, you need to look at your circumstances to decide whether or not you still do need to file a tax return. Okay, this is actually a question that I've received, and it's actually something that I've seen happen more and more recently. To tell you the honest truth, I'm in this particular scenario. My husband is with me. We've immigrated from South Africa about 3 months ago, and he is working for his South African employer. So I get this question all the time from many clients saying, I'm working for my South African employer. Do I have to pay tax in South Africa on this, right? So your starting point is, what is the source of employment income? Very clear, crystallized in the courts, saying it's the place where you physically render your services day in and day out. It doesn't make a difference if you are employed by a South African employer, yay or nay, or where you are paid. So in principle, that income is not taxable in South Africa. Okay, but there's a big but. Okay, so the but that comes in here, there's a couple of things that you do need to be aware of, right? Each employer has got a slightly different criteria as to what they will ask you for to stop the monthly payroll withholding, right? Every employer has got a slightly different risk appetite. I have seen some employers say, give me a tax residency certificate, give me the declaration of ceasing tax residency. Others get very confused and saying, you need to prove to me that you've been out for 183 days and 60 days continuous, confusing the residency, concept of residency with your foreign remuneration exemption. But what is important, you do need to have that conversation with your employer and saying, I know that I'm not resident, I'm not working in South Africa. In principle, this employment income is not subject to tax here. What do you need from me to stop this payroll withholding? Okay. And then on this point, you do need to just be aware if you are still coming back to South Africa. Now, this could be work or non-work related. There are certain circumstances where you are going to have to continue counting days. Okay, so when we're looking at source of employment income, if you're coming back to South Africa and you're working, it might be a day a month or 2 days a month, whatever. In principle, the income relating to that one workday would be taxable in South Africa. And so you need to manage your time. Now, as I've said there, once again, it depends on how you tax immigrated. You can look at the double taxation agreement to say your new country has sole taxing rights to this income. But unfortunately, this is once again not necessarily going to be a black and white answer. It depends from case to case. It depends on how you tax immigrated. It depends on who you're working for. It depends on how much time you spend in South Africa. But it is something that I want you to be aware of. Don't just assume you've tax immigrated and hence South Africa does not have taxing rights to any of your employment income. Okay. Another point that you might say, well, it's not something that I'm worried about, right? I'm working abroad. This is an employer risk, right? But be aware that you working in another country can create a risk for your employer in that they could have created a corporate tax presence in that country, right? And this is particularly where you have retained this traditional employer-employee relationship. And my advice is really about transparency. Rather have that conversation with your employer upfront that they can investigate this. Is this going to be a problem, yes or no? And if so, how do we mitigate this so that we can still accommodate you, right? The last thing you want to do is break a trust relationship with the employer because of something that hasn't been just a little dotting of the T's and that you haven't thought about, okay? So we've got a lot of questions and this actually is a natural point for us to take questions. Where did we last stop? Okay. Okay, so if you're based in another country, but you're working for a South African country, I think you meant employer, and getting paid into a foreign bank account, does this need to be declared to SARS? Okay, Emma, I'm not certain if I've answered your question, but in principle, if you're not rendering your services in South Africa, then it's not taxable in South Africa. And once you've changed your tax status, your tax return only needs to declare South African sourced income. It is not South African sourced, so no. You might need to, if your employer has continued to withhold pay as you earn, you might need to actually, you would obviously, my advice is you would declare it to SARS, but make sure that your employer has coded this income so you can get that tax refund from SARS. But if it's not the case, then you do not need to even declare this in your annual tax return. What is Gerald is asking, what is the tax implications if you still have unit trusts, but you've tax immigrated? Those unit trusts are CGT assets that would have to form part of the exit charge. You can get a simulated, basically you would have to determine what's the market value on the date that you emigrated. It is potentially going to be in a profit situation, and that is something that you had to declare to SARS as part of the exit process. Okay. Great, Emma, I'm so glad I've answered your question. I am conscious of time. My timekeeper has just told me I've got 5 minutes, but fear not, if employer does mitigate. No, I'm sorry, Anonymous. Unfortunately, the fact that there's a continued SA payroll withholding in South Africa does not mitigate your employer's risk. Okay, okay, there we go. Okay, so I am aware, and I'm hoping not to rush through the rest. Literally, there's 2 more topics that I want to touch base on. This is really a hot topic at this point in time, and it's got to do with your retirement funds. So as I've mentioned before, the whole concept of financial immigration has fallen away from March 2021, and there was the one link between exchange control and tax. Was this particular provision that before March 2021, where a person wanted to extract themselves from their retirement annuity, and as you know, you can only extract yourself from an RA on maturity at the age of 55, or where you had put your money or your retirement funds into a preservation fund, and you had already made use of that once-off withdrawal from that fund. Basically, you couldn't exit those until retirement. But the Income Tax Act made provision that where you financially immigrated, you could extract yourself. Okay. So with financial immigration falling away, they had to change the income tax legislation accordingly. And so the new condition for you to be able to withdraw is you need to prove to SARS that you have been non-resident for 3 continuous tax years. Okay. And hence it goes back to my point of rather get that proof of when you ceased so that you can do your countdown for 3 years if this is something that applies to you. Okay. Conscious of time, and I'm going to quickly touch on this. This is just a proposed change in legislation that is going to come into play March next year, March 2022. So as I've said, there is a handful of double taxation agreements that do provide for a bit of tax planning and preferential taxing of retirement benefits, in that if you had to withdraw, you don't pay tax in South Africa, but you in principle pay tax in your new country of residency. Right? SARS saw this as a loophole, even though there's probably maybe 6 DTAs that, or countries that you can move to and potentially make use of this. But they saw this as them losing money. And so what they're looking at is introducing an exit tax on retirement. So on the day that you basically tax immigrate, it's deemed that you withdrew from your retirement or your plans the day before, and they apply the taxing rates applicable to withdrawal. As you know, South Africa has got 3 progressive tax rates. One is normal income tax. One is a progressive tax rate for retrenchments and retirements and so forth. And the third one is on withdrawal. So if you actually resign and you take your pension money out, there's a withdrawal rate there. It goes from at 18 to 36%. So what they're saying is on the day before, when you immigrate, we are going to calculate the tax on all your retirement vehicles as if you had withdrawn. Okay, they are postponing the payment of the tax until you can actually take the money abroad. So it's either on retirement or once you've met your 3 years. But for that absolute pleasure, they're going to charge you interest, currently at 7%, until that date that that tax is paid. So as you can understand, this is once again a very hotly contested piece of legislation. Many people are saying, but I'm potentially going to still be paying double tax. My retirement fund doesn't grow at 7%, XYZ. It's very hotly contested. I have not seen the Treasury has come back. The stakeholders had until the end of August to submit their comments to this piece of legislation. And we will keep close to this and see what transpires at the end of the day. My opinion is, knowing what SARS does recently, they implement and they deal with problems later. Please, please, please be aware of this date and understand whether you are impacted or going to be impacted by this, yes or no. So in view of time, I'm going to pause on this one. As I said before, with the modernization of the Reserve Bank, they have basically aligned exchange control residents to immigrants, what you can take out. So if you're an immigrant, in the year of immigration, you can take out 1 million travel allowance without a tax clearance, 10 million in cash, 1 million goods and assets. Subsequent years, you can take out a further 10 million each year for each calendar year as a foreign investment allowance. So you can see that the two are very much aligned. The only difference is an exchange control resident can make use of their 1 million discretionary allowance per annum, whereas an immigrant is basically limited to your year of immigration. Very important, and I think somebody had asked, so when you, in both cases, if you want to take out more than 10 million in a particular year, you do have that option available to you. It is going to be subject to quite a stringent process of verification. They need to check that it's not money laundering, XYZ, but you can apply and get more than your 10 bar out per year. And somebody on the question that was posed was, you no longer have the concept of blocked accounts. Do I need to take it out as my foreign investment allowance? You potentially have this as recourse, saying, I want to take it all out, and it is an application that you can make to the Reserve Bank via your authorized dealer. Okay. I want to just pause on questions. Let's see. I'm going to start at the bottom, work my way up. Okay, and not wait for 3 years. So, Dave, I'm not certain where, hang on, sorry, I just started the first question. So, if the negative withdrawal from your pension, you've asked if it's negative to rather withdraw and paying withdrawal tax, right? So, yes, then that is why there's a bit of a mad rush at this point in time where I've seen a lot of people saying, well, I want to resign from my retirement vehicle. And actually take the money out up front, right? So you are right. If you are resigning, you actually have access to your funds right now. You will pay your tax at the retirement rates, but you can take it out in full and you do not need to wait your 3 years. It's only where you put it into a preservation fund. Also remember that when you resign and you put your money in a preservation fund, you are entitled to a once-off withdrawal. Now, there's nothing that prevents you from withdrawing 100%, but that once-off withdrawal is not subject to the 3-year rule, right? So you pay your tax and you can take it out there. Dear Waltz, you've a follow-up question on the unit trust. Can you still keep? Yes, of course. There is nothing in the legislation that says you have to sell anything, right? It's just what they say is we want to get our piece of tax right now because we don't know that once you're no longer in the country, you're not resident. And as a non-resident, your CGT in South Africa is limited to fixed property, in essence, fixed property in South Africa. And so any future gains that you realize after tax immigration on your unit trust that is held in South Africa is not going to be subject to SA CGT. Hence the reason you have the exit tax. You calculate your gain up to that date. They've got their pound of flesh. Any subsequent disposals or increase in value in your South African investment will not then be subject to South African CGT. I hope that I've covered, and I think Emma, you've said you're okay. I have gone through all the questions that I can see. It has been a pleasure talking to everybody. If I could just leave you with one final thought is, if there's anything that you do need to do is, please do your homework beforehand. Don't make any decisions without having consulted, understanding how the legislation applies to your particular facts. So understanding what are the tax immigration options that are available to me. When do I cease? Do I need to count days? What assets are going to be impacted? XYZ. So once again, I just want to thank everybody. We will be sharing the slides with those of you who want to. So please drop us a note and saying, please share the slides, and we will happily do so.